Fed Day Eagles. How are the Eagles today? Are you in your nest or ready to fly? Personally, I'm going to sit in my nest until after the Fed, but I do have some ideas, especially if the Fed isn't hawkish and they sell the dollar off. Everyone doing okay, Tolton? I saw you in here. Thanks for following me here to Face. Hi, Patrick. Alexander. Oh, you're very welcome. Yes, Alexander's reminding us that Peter Goodburn's going to be with us. Just a quick refresher. Last April, Peter was an uber bull in the indices, and I thought his numbers were crazy. Back then, I think we were trading, I don't know, 2,200, something like that. And he was looking for 2760, overshot his upside target, so it's going to be interesting to see where he's at with that and the dollar and the euro. I'll ask him specifically about the euro, and hopefully we'll get to oil, gold, and bonds too. So stick around for this interview. He was one of the most bullish guys I had on since we started Face, and I think he's changed his tune because I was in touch with him last week. So the dollar, if there wasn't a Fed, I'd probably try it here. It almost looks like it wants to put in a higher low, and that we get something like this from here. But because of the Fed, I wouldn't rule out one more push down. The way I would approach it is a scale in buy, and I'd even buy new lows for this reason. New lows I don't believe will confirm on the 4 hour. I have a fib at 88.32, so it's a possibility we just get a stop hunt on a not so hawkish Fed. You know, if the Fed is hawkish and we don't break and, you know, the dollar rallies, I'm not going to fade that. But if the dollar is weak, this would be one of my buying candidates. Do I need to tell you that I think within a few hours we're going to have a super moon, the biggest in 100 years, and on top of that it's going to be red like blood on the streets, and then it's going to turn dark like Pink Floyd, The Dark Side of the Moon, total eclipse this morning. So if I'm a little unbalanced, I'm sitting here underneath my pyramid with my tinfoil hat, and it tells me that my idea yesterday to look for one more high in the Aussie for a third drive up towards 81.5. I just want to show you guys this on the 1 hour. It's amazing how this moving average, what kind of action you're getting off this. 200 on the 1 hour. So I'd like to see one more high. If not, back under 80.50, 80.40, you got to be short Aussie. I'm thinking we get a third drive up here, 81.40 to 82. Again, a scale in type of position. You put your toe in the water. I wouldn't do this until after the Fed. Okay, the euro stronger than cable, but you know, it's kind of a grinding action. Could it blow to new highs? That's what I was looking for, but maybe not. You know, maybe this was some type of A and this is some type of B with a C to come, and cable's even a little weaker here. So it's hard for me to get real bearish a dollar, especially I think Aussie is very close to a dollar long against it. And oil, I think the back is broken in oil, something we talked about last week, and Steve showed it rolling under the trend line. I think you got to sell fib retracements of this decline. I think that the hedgers are so short oil, and they really started shorting the oil, building their positions, you know, all the way in here, you know, before we even got to 60. So it's my contention that they're going to get bailed out of their shorts, the commercials, and they'll take it under 60. So we'll see. That's, to me, looks like a topping pattern that we had here in crude. I think basically the whole theme is going to be a dollar recovery. I know the dollar looks ugly. It looks ugly. But I'm thinking a dollar recovery, which has been a tailwind for things like crude, weak dollar, higher crude, weak dollar, higher indices, weak dollar, higher metals, that we're going to get a little bit of a dollar bounce. I would use this rally in S&Ps. I don't know if we're going to make new highs. I'd be looking for some type of fib retrace off this. 2850, 2860, if we get that. I would be anticipating a failing rally, even though I have a confirmed high here. I think that this sell-off here did enough short-term damage, and I think we're up because of the optimism. The president delivered a very good speech, and people walked out of there feeling warm and fuzzy. So we'll see. I think that this is a sell, that we have a potential top here. We have a potential reversal week to the downside, and I'm expecting it to finish lower. Also going to be interested to see what Peter thinks as well in the S&Ps. So any questions for me? You guys get where my head's at? I would use the Fed if they sell off the dollar, rally the S&Ps, rally Aussie to new highs. I would fade that action. You don't have to agree with me. I just want to make sure that some of the things I've said to prepare you for the Fed today, that you have clearly. Just give me a why. You could have your own view. Just want to make sure you get mine.
Hey Dale, in regards to the eclipse, right? It's an eclipse.
Yeah.
Yeah, I was just out there with my kids and my wife, looking at it, since we're an hour ahead of you. So I was just looking at it.
Out there?
It is over here, yeah.
Oh, yeah. You're lucky because it's overcast here.
Oh, as it normally is in San Diego, you kind of yeah in the morning.
So is it cool?
It was orange, and then it started to get a little. It was an orange. It was really small. Okay. And then it started to get a little darker, but it was cold. So, and cold for us is like 55. So we had to come back.
Minneapolis, they're driving their convertibles at 55.
Yeah, pretty much. Well, actually here in Phoenix, we do the same thing. So
anyway, I'm in awe of these movements of nature in the universe. I just it really puts everything in perspective. We think
it sure does.
How important we all are, and we're just grains of sand.
It shows you we're just a little speck in all in the grand scheme of things. So
let's get micro and make some pips. I don't know what I don't know about you, Blake, but I've been advising the community to kind of sit on their hands until after the Fed, and if the Fed is benign, look to fade dollar weakness.
Well, first of all, let's keep in mind it is the end of month, and we have had tremendous dollar selling for the last 31 days, and then some. So the chances of the dollar recovering today are going to be very slim, unless there's something very big that jumps out of the FOMC statement. Now, remember, it's only a statement. It's not. There's no meaning here. So chances of them raising rates unexpectedly is slim. If they do, I would absolutely it would kick off like the biggest dollar short squeeze if that happened. But chances of that happen are
maybe the NFP, because then it lines in with a new month, right? Wrapping up, month end type of stuff you're talking about, and some type of inflection point.
Yeah,
more than today.
Right, more than today. I would agree with that. The chances of the dollar weakness easing today is probably pretty slim. We've got ADP numbers coming out here in just a couple minutes. That's why you see I've got the dollar yen up currently. Yeah. So that's going to be out in a few minutes. Then we have employment cost index that's going to be coming out as well. You can see the dollar yen's trading in a little bit of a triangle here. You've got the like I said, the employment cost index I think is an important number for today, probably more important than ADP. That comes out in about 30 or 20 minutes. And then really the key to today is the FOMC. But like I said, unless something materially changes, people are looking at there's like a one-liner that really should be watched is when in the FOMC statement there's a the language they talk about inflation. It says market-based measures of inflation have moved up considerably but are still low. If that language changes, like, it says like, market-based measures of inflation have moved up considerably, and period. Yeah, and that might, spook some dollar buying, some shorts to cover. But remember, again, I have to focus on the fact that we are in a very big down move in the dollar index. You can see the dollar index has just been very strong. So unless the dollar index gets back above, like, I would say 90, maybe, let me grab this trend line here. Yeah, probably 90 and a half. There's no reason to be long the dollar. You might get a squeeze, which would be definitely be unexpected with the market right now. If we got a squeeze out of the dollar, if the dollar just squeezed higher, it'd be like, wow, where'd that come from? And I think a lot of people would be caught off guard because of just the strong dollar move we've seen.
The positioning is still very skewed on the COT towards dollar bearishness.
Yeah, it is. It is. It's extremes. But I was listening to a call actually about 20 minutes ago that I think it was Morgan that was making comments. It's extreme, but it's not too extreme. Based on where currencies are at right now and where the euro is at, and based on previous moves. So, my thought process is really simple. Any type of dollar rally that we get today will probably be faded. So, but at the same time, the question is, well, if the dollar sells off, what do you do? It's hard for me to chase it in the at this stage in the game too. I'm not going to sit here and go, okay, well, just start buying the dollar aggressively again. However, like I look at the euro dollar. Let me just take you over to the euro really quick. The euro's up against the 618 retracement. You can see how we're nudged right up against the 618. We haven't been able to break above that all night, but we might be able to do that today. It might finally break loose a little bit because the dollar is weak against, you got the Aussie and the Kiwi that are strong. Even the Aussie after the CPI data last night is strong. So, and people keep asking, why is the Kiwi so strong? The Kiwi is so strong because the Aussie New Zealand sold off aggressively. There was a lot of people getting very bullish the Aussie New Zealand the last week, and that CPI data really just killed the Aussie. And it really killed the Aussie New Zealand, which the New Zealand dollar benefited from that, obviously.
What a vicious pair.
Yeah, it did look
good the day before today.
It did. And we got a little head and shoulder pattern and slumped. All right, here's the let's go over to the dollar yen. We got ADP numbers. Market's looking for 185,000. And let's just see how the market responds to this. 185 is what the market's looking for. We had 250,000 the last time around. And stand by.
You're like a reporter on CNN right now, man.
No, about that.
Steve Leisman on CNBC.
Don't even say that. But we shouldn't get too big of a reaction here. I don't think this is going to be very, it's probably going to be 30,000 above or below. It's not going to be any huge reaction here, I don't think.
All right, Rick Santelli at the Board of Trade.
No. Okay, it's a good number, 234,000.
Yeah.
It's a good number. But don't expect it to last. Dollar yen spiking up a little bit, but you know, again, it's probably not going to be sustainable. We spiked up a little bit, and you know, it's just
dollar didn't weaken much at all.
No, you can just see it fading again. It's, you know, nothing. Euro dollar came off a couple of pips and then look, bounced right back. I mean, this everybody's shaking off the ADP. Prior month was revised down to 242,000. So that hampered it a little bit, but overall, you know, it's a good number, but I think it's not going to be enough to really spook too many, you know, dollar traders. You might see a little bit of dollar strength coming in, but it shouldn't be anything.
What do you think about USD CAD down here? Like,
you know, it looks weak. It looks really weak. Actually, it spiked up to 122.90 just a few minutes ago. Wilbur Ross was on CNBC saying there's, you know, so much work that needs to be done on NAFTA, and all the hard issues there's been no progress, and so the dollar Canadian spiked up on those comments and then came right back down. Dollar Canadian, I have to say, it has. If you look at the way the dollar Canadian has acted versus like the Aussie and the Kiwi, it is held up very well.
That's why I asked you. It almost looks like it does want to put in a higher low here.
Yeah, I mean, you know, but do I think the dollar Canadian's going down to 121 and change first? Yeah, I think that's probably realistic. I mean, you know, as the Kiwi hits a new trend high, you know, the Kiwi's probably going to, you know, 70, you know, probably up here to 75 cents, something like this. Yeah, the Kiwi. Yeah,
1.582.
Yeah, I think I was listening to what you were saying earlier. That looks realistic. I don't know if we're gonna, you know, head up there today, but it looks, you know, realistic. You know, remember Australia had really weak CPI data overnight too. So I think that a new rally or a new high faded, but let me also say to you guys that if there's a new high in the Aussie and you want to fade it, but you want to stay away from the dollar, probably the better trade is maybe Aussie yen short, or maybe Euro Aussie long, or pound Aussie long. You know, some cross rate versus being mixed up in the dollar right now during, you know, this down move till we see the dollar. Yeah, until we see the dollar really put in a bottom. And I was going on to talk about some of the dollar flows that we're seeing. I mean, chances are, because it's been such a strong dollar move, we're going to end the month at the lows. The dollar index is going to end the month at the lows, and probably tomorrow you're going to see, you know, portfolios get back into dollar shorts as they do what was working for them. Now, will the dollar move sustain to the downside after, you know, the next couple of days? Well, maybe it is the jobs report that changes the picture a little bit. But I'll tell you, being a dollar bull right now is very tough business, and you know, unless we start seeing some, you know, higher highs being created in the dollar, it's very tough to make the argument that the dollar is going to turn at this point. You know, I'm more apt to buy the euro on a dip. I'm kind of hoping the euro dips below 124 today so I can pick it up. I just don't know if that's going to happen. So, you know, when you talk about like the Canadian and you ask about the Canadian, Dale, yeah, I think the Canadian is definitely outperforming with dollar strength versus its peers. It's looking much better than the Kiwi. It's looking much better than the Aussie. So when we see a dollar bounce, whenever that comes, whether it's today, whether it's tomorrow, whether it's Friday, whether it's, you know, 2 weeks from now, I think you're going to see it show up in the Canadian before anything else, if that makes sense to you. But you can see these dollar moves are faded. I mean, look, the euro's right back at its highs. I mean, you know, look at the euro. You know, we dropped to 48 and scooped right back up again. You know, people are not interested in buying dollars today. This is a sell the dollar tape at the moment, and it looks very you know, persistent. Doesn't look like that's going to change. Like I said, there's got to be a very big change in the FOMC today to really shake the trees of anybody who's short the dollars, short dollars right now. One other thing we should probably take a look at is the S&P. The S&P it is getting a bounce overnight. It's going to be interesting to hear what your guest has to say about the S&P, since he was so bullish, and it sounds like his tune might have changed a little bit. Dale, be interested to hear what he has to say. But you know, if you look at the S&P, we broke through this, you know, this minor support. We're getting a bounce. State of the Union last night, if you guys didn't watch it, you know, for Donald Trump, I think he did a good job. I really do. I think he did a good job, and I think the market is probably responding a little bit that hey, you know, he didn't go off the rails, or he didn't deviate from his, you know, his canned speech, and overall was a pretty positive State of the Union. It wasn't you know, any real strong rhetoric towards trade or anything that.
Korea, he didn't come out and say that we were going to denuclearize.
No, I mean,
he just brought out the people that suffered in North Korea.
Yeah,
but he wasn't bellicose and aggressive.
No, he wasn't. And
he planted the seed. Like, look at all the suffering that's going on there. So morally, if we have to do something, we're just taking down a pretty vicious society. That was my take.
Yeah, and maybe you know, maybe he's sowing the seeds for that. I mean, it could be the case, but I think the market has had a very positive response as a result, or a, you know, a fairly positive response. But you know, could we be flagging in the S&P? It's entirely possible. This is a 4-hour chart, so I think you just got to you know, for today, just be careful if we start trading below yesterday's lows. I mean, if we start trading below yesterday's lows, that's not going to be that's not a bullish event. And then
Blake, is if the S&Ps are bad and oil is peaked, that I think a lot of it's going to be generated by. I think the dollar is going to rally under those conditions. So I haven't had any proof yet, but to me it seems like the market likes a weak dollar more than a strong dollar. We were down, the dollar was up pretty good on Monday when everything came in lower, and that began the stock market sell off. Dollar soft today, S&P's up. So I'm just noticing, I think that S&Ps during a correction will be dollar friendly.
Yeah, I agree with that. I think the dollar is it's definitely more business friendly at this stage in the game. It's not disorderly to a point where people are worried about like the credibility of the dollar. So yeah, the weaker dollar probably goes hand in hand with stronger stocks. However, you know, and the comment I wanted to make here is, if the stock market does sell off, and let's say we get a continuation, you know, just for argument's sake, let me get hold on, I'm trying to clone that. So let's say we get a continuation and we start to break lower in the S&P. If that's the case, then we are then going to have to reassess what we're doing with the dollar, because the dollar might catch a bid. You know, if the S&P is heading lower, we don't know that yet, but it is something that I think, you know, we should be paying attention to, just in case. You know, I think it's going to be a concern should the stock market turn lower. We got to start taking a look around and seeing what those, you know, what that correlated move might actually look like. So yeah, that's the way I'm looking. But you know, the S&P, it's, you know, we still have in order to turn lower like that, we have to break through yesterday's lows. There's no if, and, or buts. And right now, it doesn't look like that's going to be the case. Right now, it looks like we're probably just going to continue to grind back up here towards, you know, 2850. I don't think there's anything that's really shaking the market and that's going to shake the market too much. at this point. And like I said, the State of the Union was more of a non-event at this point. There are, I have some pretty strong trend lines that I'm looking at. Like here's the U.S. dollar, Norwegian krona. As long as we stay below that trend line, it's bearish. The pound dollar is, it's very tricky right now. I'm looking at it more as, as long as we stay above this 140 level, this is going to be key support. So as long as it stays above 140, I think if you're bullish, you don't really have to worry about it too much. The euro dollar, we've got this green trend line that's in place and not breaking. So that's going to be important for bulls. And so and then we have our channels in the Aussie and the Kiwi that are prominent. So as long as all those hold, all these support levels hold, then the dollar's probably going to continue down. You gotta use this these rallies as opportunities to be a seller of dollars. And like I said, I think it's post FOMC that's going to be more important. I think if you're establishing dollar trades, you've got to be looking at post FOMC versus doing anything currently. And with that being said, I'm going to turn it over to my colleague Steve. Steve, how you feeling today? I don't know if Steve's here.
Hey, Blake.
Oh, he is. Oh, okay. Hey, yes, Steve. How you?
I thought I unmuted myself, but I misclicked, as it seems.
How's your throat feeling today?
It is a lot better. A couple of days of antibiotics have already started improving the situation quite a lot. How have you been?
I wish I slept better last night. I got up in the middle of the night. I was hungry, so one of those nights that I think I didn't eat enough. I didn't eat enough last night, and so I got up starving. So other than that, nothing that's the ordinary. But doing all right.
Raiding the icebox at 1 in the morning.
Yeah, I was actually making a peanut butter and jelly sandwich at midnight. Yes, I was.
Actually, more or less, I had the same with you yesterday. At some point, I hadn't eaten much during the day. My appetite has not been very good. This last couple of days, and at some point, I felt like empty stomach, so I was eating spaghetti in the middle of the night. So I feel you.
That always helps me sleep better whenever I have I fill my stomach a little bit. But hey, the dollar. I just wanted to point out, dollar continues to stay weak. As
Absolutely,
I was telling the guys and gals here, it's probably going to stay weak until, we have obviously the London fix. Around 11 a.m. Eastern that could influence some flows, but more importantly, it's we're going out.
Last day of the month as well.
Yeah.
In general, I mean, I think the end of the week or the beginning of next week, from a seasonality perspective, as well, might be a better period to perhaps look like for a stronger reversal.
Yeah. I would argue the same. So with that being said, I'm going to pass it over to you as I get ready for the ECI. And you guys have a great trading session today. And don't forget to vote for your best new analyst on FX. And I'm sure Steve will give you the details.
We're getting a lot of votes. 10 months of face, Blake. We've just cracked the 4,000 number of registered users to our webinar. 4,035.
Great. Hopefully they're all voting for us. So I really appreciate it. And if you guys enjoy what we do here, please cast your vote. I mean, if it's free and we do it daily.
And don't forget Grega.
Don't forget Grega as well. Okay, I've got to go. See you guys.
Okay, but see you later, right. Blake. Okay. By the way, we have. Let's go straight to Canadian, because we have Canadian GDP coming out like now, I think. Let me see. Yeah, at the bottom of the hour, I think. So it's a few seconds left. So let's see what we get from Canada before we start looking at other things. But by the way, Dale, you remember when you told me that we had hit 3,000 people? I told you that. Yeah, I told you that it's okay. It's another milestone, and you were a little bit disappointed with my response. Well, but as you see, how much time did it take us to go from 3,000 to 4,000?
I don't know.
Just, what is it, a couple of months maximum?
Yeah.
The Canadian GDP exactly as expected, plus 0.4 versus plus 0.4 month on month. So having to do with the print, nothing that should create a response, but let's see a little bit. As you see, by the way, the USD CAD has already broken the triangle to the downside. It has been testing today the 78.6. Obviously, it remains quite bearish. US Q4 employment cost index 0.6 versus 0.6, some secondary data from the US. So nothing to see there as well, exactly as expected. Okay, so, okay, obviously no response since we didn't have any surprises coming in there. Let me see if we have any other secondary data. Year on year 3.5 versus 3.4 for Canada. So the year on year is slightly better than expected, 3.5 versus 3.4. Industrial production 0.1 versus estimated minus 0.2, so a little bit of a bit there. Raw material prices index month on month 0.9 versus minus 2.3 expected. So okay, that is positive for inflation. So in general, you know, the main data from Canada came as expected. Secondary data a little bit better. Nothing to write home about though. Okay, I think Blake mentioned it before. If you remember, I was showing this formation yesterday as likely as a pennant in the Euro USD. Today's move higher, you know, adds higher likelihood that, you know, increases the likelihood that actually this is the case. More or less same with cable. I think Euro at the moment, the past few days, looks somewhat better. I mean, the consolidation was a lot more flat, although yesterday's reversal in cable was a little bit better. But today's follow through is better in the Euro. Regardless, I think that, you know, as long as we remain above 123.10 in the Euro USD, you know, there's absolutely nothing to discuss about having to do with bearish scenarios, and the next target remains at 126, which is the 61.8 of the whole move that we had lower here, right, from the middle of 2014. So I think Euro remains on track. Blake already mentioned, I know, that mostly the move we've been seeing in Kiwi is a product of the Aussie Kiwi. As you see, the Kiwi remains very strong. Yesterday, I mentioned explicitly that, you know, the fact that 4 days in a row we were trying to push below this blue trend line, and not a single day we managed to actually close below it, is something that shows that Kiwi might have another push to the upside. Today we're seeing this. The next resistance is actually just a little bit higher, you know, this high and that high. And if we actually at 74.35, and if we actually pass that, then the last target is obviously that high at 75.60. I'm still expecting some correction to unfold sooner rather than later, but, you know, the market remains stubborn. The ascending channel is still doing good, and as long as that's the case, you know, we have no trigger. So, you know, expecting it is one thing, but, you know, seeing it happen is a totally different thing. Now, having to do with the dollar, Blake already mentioned that, you know, the tape is bearish for now, and indeed we're once again going towards the confluence of supports that actually did produce a very nice reaction at the end of last week. But you know, it's not impossible to break below it. Anyhow, we haven't seen any real bullish break, because if you remember, I mentioned explicitly that unless we break above 90.10 and more importantly 91, any type of rebound is not like a confirmed reversal or anything else, right? So we have been moving lower since November. We only had like a couple of months of little correction, and as it seems, you know, the trend remains lower for the dollar, and it's as simple as that. Let me have a look at a few of your questions to get more ideas of what you want us to have a look at before I resume. Stelio, are you here?
No, he'll be back in a few.
Okay. Okay. Yeah, he's going to put the link. They're asking for the link to vote. Stelios is going to put it in a few minutes when he's back. Open interest net long non-commercial extreme on euro and net short on yen suggest USD could be close to bottom. We all agree with that, Dan. We've all said that the dollar remains very bearish, but we do expect that, you know, sooner rather than later we're going to have some very nasty reversal because, you know, as you point out here as well, there are a lot of elements that point to extreme positioning, extreme sentiment, etc., etc. So the dollar will be susceptible to a big reversal at some point, and I don't think that point is far away from here. Greetings, S&P 500 will get a break below 2.8K. Listen, first of all, in the S&P we had the first move, which was actually breaking below this ascending channel, a very steep ascending channel. And you know, the next area of support actually here, if you notice, is just above 2800. It's, I would say, 2807. Keep in mind that this is an extremely bullish market. I mean, this is a market in a mania phase. So just because we saw 2 days of selling doesn't necessarily mean anything, because if you look at it, we haven't actually managed to break even a single important support level. I mean, literally speaking, and not going into too much granularity just because the trend is extreme, the first area of actual support I see here is just below 2700. Look at this, it's this one. So in essence, you know, even if we move another day lower, etc., we haven't actually managed to make any real bearish break. Yesterday, I actually closed my S&P, then reopened my S&P when I saw that the tape was bearish, made another 10 handles to the downside. So, you know, I've been in total, I've taken a loss here, even by making 10 more handles yesterday. I took a loss because I expected a reversal sooner. So at least, you know, I was patient. I thought that Friday's move is a move that's going to be retraced because it was out of context. And at least, you know, I managed to escape here with, you know, around 1% of a loss. Given where it was, it's fine. And you know something, I don't see the signs yet. I mean, we at least need to break below 2807 to start considering other possibilities. Keep in mind, we also have this as a possible support area. I'm not saying that it cannot move lower from here. I think it can. But what I'm saying is that we need to be very careful because confirmation is nowhere close. That's all I'm saying. Okay. So we need to see a couple of events happening or a couple of things that will, you know, provide the catalyst for a bigger sell-off, because a 2-day sell-off is not enough to rally the troops, to get people really agitated or afraid or whatever. As it happened with Bitcoin, you know, that people were just in buy the dip mode, and they didn't even care about intraday swings of like $3,000. You know, it took some time until they actually started viewing this as something more bearish. By the way, speaking of Bitcoin, I have a target here just above 8,500. We're slowly dripping there. I still don't see this as a very, very strong sell-off. I do think that it can move lower from here, but I think that only if we break like below the 7,500 area, things might get very, very nasty. Okay. Do you think the dollar has, knowing the fact there are no rates, could we see an opposite reaction with upside direction? We saw this happening in the beginning of 2017. Rates hiked and dollar dropped. The dollar was dropping, knowing the fact that, listen, it's not about, you know, an exchange rate and any financial market is a discount mechanism, meaning that it looks forward in time and doesn't look at today. So meaning that hiking or not, it doesn't really matter, because what matters is what the market was already pricing in, and if we got any change to what the market was pricing in. So for example, if the market is pricing in, let's say, 3 rate hikes and you get a rate hike and at the point that it's expected, you should not expect to see a reaction to the upside, simply because that was something that the market has already priced in. Now, if you get something that will suddenly make the market believe that, oh, I'm not getting, let's say, 3 rate hikes, but I'm going to be getting 4, that's what's going to move the market. Or the opposite. Let's say the market is pricing in 3 rate hikes, and suddenly it sees something, or something is being said or communicated one way or another, that we're going to get 2 rate hikes. Okay, then it's going to react. So by predicting of if a market is going to react to something positively or negatively, you always have to start, and that doesn't only affect rate hike. That does not only involve rate hikes. Anything that can affect an economy, right? You always have to start by saying, okay, what does the market already think is going to happen? And X thing happened, X announcement or whatever. Okay, should that change the expectations of the market in regards to what it was already expecting? That's the only thing that matters. And in exchange rate, you also have one more element. You have to do the same thought process for 2 economies, right? Because let's say Euro USD, let's say the Euro is doing better because let's say the Eurozone economy is doing better. But if at the same time the US economy is doing much better, then Euro USD is going to be weakening. So in exchange rates, you have to go through the same thought process for both the currencies involved. Okay. Will you explain the difference between impulsive moves versus corrective using Kiwi as example? The fundamentals for NZD have been poor, including the new government. Thank you. Yes, I can definitely explain that to you. I can also tell you in advance, Bill, that it's very imperative whenever we judge impulsive and corrective moves, very imperative. It's the first thing you should begin with, to define well what kind of time frame we're talking about, right? Because this is a different view, right, that I'm seeing here. This is a different view by zooming out a lot than this. Okay, so if you showed me this and you told me, does this look like an impulsive move to you? I would tell you, yeah, it definitely looks like an impulsive move to you, to me. Now, if you zoom out and you ask me, does this look like an impulsive move? No, it doesn't. It doesn't matter that some of its elements look impulsive in the short term, right? In the in the great context of things, this is the impulsive move still here, right?
That's why you always have to zoom out and not be too micro.
Yeah, yeah. You should never be trading on a long-term chart like the one we're seeing now, but you should never, ever not know exactly what the long-term chart says, right?
Because so should that give you your bearish bias looking at this?
Exactly. That's what I was
going to say. You just have to wait for the short-term stuff to line up.
Exactly.
Give you the signal with the longer term trend.
Exactly. That's what I wanted to say. And if sometimes, because I remember when I was a novice trader, it was happening to me as well. I was seeing at more experienced traders than I. For example, my mentor had been my uncle. My uncle had been, a Forex trader that was working in some of the biggest banks on the planet. Had worked in several countries, so he had a lot of experience many decades ago. But he was a pioneer in at least for local standards, and he did very well for himself. And many times I didn't understand, for example, why he was persistently looking at X direction, while the chart I was looking at was telling me like, why the hell does this guy really want to be long this or short this? I mean, this thing has been relentless in X direction or Y direction, the opposite direction. And then you realize is because he first had in mind the long term. So if I'm looking at this chart, I'm like, okay, I still have absolutely no reason to believe that the Kiwi is bullish, right? So I'm going to be still looking for opportunities to be short the Kiwi instead of the opposite. Let's go to the Aussie and have exactly the same look at it. right? I'm not saying that they cannot turn bullish. For example, if we break above here, let me zoom out. If we break above here decisively, I'm going to start rethinking of my general Aussie thesis. You know what I mean? But unless that happens, what do I see here? Boop, 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 boop. What's this? Does this look like impulsive to you in the grand context of things? No, it doesn't. Why? Overlapping, slow, retracing only a small part of the move down in a very large period of time. Bottom line, my experience tells me that this is a market that intends to correct more in time than in price. Can that prove to be a wrong thesis? Yes. But statistically speaking, no. Meaning that for out of 100 times that I'm going to see a formation like this, I know that 70 of them, something like this is going to follow. So, you know, just stick to your plan, trade what you see, and don't lose your faith to what your experience tells you just because it doesn't always work out. That's it. Could you please confirm if gold is currently in a down wedge? In a descending wedge, you mean, so you mean a bullish descending wedge. Am I right on that, Mazed? Okay, let's have a look at it. Can you also give me some time frame? Is it viewable on the daily? No, I see what you mean, doesn't matter. I see what you mean. Yeah, listen, you don't call them descending wedges if they're on a bullish trend. In essence, you're asking if perhaps this is another pennant. Let's go down to the 4-hour chart. So you're asking if this is a formation you should be viewing as a bullish one. Like, you can draw it probably like this. And in this case, it's already broken. Or you can even view it as something like this. In both cases, and it doesn't matter, I've explained a billion times that corrective formations, you know, you cannot know in advance what it's going to be and end up being. I agree with you. That's why I closed my gold when it dipped down for almost no cost, because I see one consolidation formation after the next. And all of them, look at them. I've drew all of them, right? Consolidation, triangle. What does it mean? Should break in the direction of the trend. What did it do? It broke to the direction of the trend. Another one. Consolidation, triangle. What should it do? Break in the direction of the trend. What did it do? It did. Another one. Yeah, chances is for another push higher. As simple as that. I would at least want to see a daily close below here for gold to be convinced that a deeper correction is coming. So call it roughly 1322, let's say. And until or unless that happens, no reason to not keep looking higher. USDR, absolutely. You remember I was very clear with what's happening here with USDR. It's one of the weakest. And you know something, in the short term, what is USDR doing now? Right? So what should you expect from here? More likely than not this. At some point, we're definitely going to have a deeper correction, a stronger correction. In that case, what's this area's first area of resistance? This one, roughly 1223, let's say. If that breaks, then we can watch higher for 1313. But so far, that same first day, and this is another example why What was this? Exactly what we're looking for the Aussie and the Kiwi, right? Boom. There you go. On the other hand, let's move longer term. What is this? Where's the impulse here? Here's the impulse here. So why should we be looking lower here? Simply because, in my opinion, this is an A, a B, and a C. So this is a corrective move, but it's still unfolding. And in the smaller context of things, you know, this can prove to be another short-term impulse in this larger correction. Then we should find at some point some type of a low, perhaps let's say somewhere there, and perhaps resume to the upside. But still more downside left here. Okay. So it looks good to the downside, very good. Actually, if you look at it, it's trading so heavily. I mean, look at this. This was a correction that we could not even push higher. This one seems to be the same. If we break the 1180, you should at least expect this move to extend by this much. Next target, let's say it's around 1140. Okay. Let me see what other questions we have. No other questions today. Have we solved everything? Come on, you're usually extremely talkative people here. Okay, let me.
There you go.
Boons, yeah, now we're getting questions. Copper, boon. Okay, let's start from copper. You remember we were talking about copper. Let's redraw this once again. Bottom line for copper, nothing has really changed. This looks to me like another corrective formation. This is what we drew when we were there. Do you see? This is exactly what we had drawn when we were like several days ago. I see nothing bearish with copper. Very strong impulsive move to the upside, following a correction, which followed an impulsive move, which was followed by correction, an impulsive move. And this is also clearly so far a corrective move. Just look at it, right? Copper likely found a bottom there. Very likely. We're going to confirm on a break above 325, and in which case it should extend higher once again. Okay. CNH, sure. CNH, in the grand scheme of things, this is what you can realize here, that the uptrend actually got confirmedly broken below 670 here, because it was like the confluence of this horizontal support area and the ascending channel. Since then, it has been an extremely bearish market, because going back to basics and consolidation lower, consolidation lower, no signal of strength whatsoever. And at some point, when we rebound, watch this area for resistance, 640. As long as we remain below 640, there is absolutely nothing that hints to a reversal yet. Okay. We are seeing some RSI divergence, I can tell you that, because RSI had reached like super extreme levels, like close to 10. But you know, that's not a signal you can use to time something. Just look at this. Even if you zoom in, this one, for example, the past few days was a short-term triangle, right? Breaking to the downside once again. So nothing to see here. I mean, just continued weakness. Pound yen. Let's have a look at it. I'm going to go through all of your questions. I'm seeing them, guys. Don't worry, and girls. Pound yen. Pound yen is doing once again what we expected it to do. It seems to be trading in a slow, choppy, ascending, likely a wedge, but it doesn't seem complete. That's why when several days back, when we had that down day, I said that, listen, even if it moves lower, you know, it might rebound from here and move higher once again. It didn't. It went straight higher, then lower. Now it's going higher again. I think this is a process. I think this is a process, and I think you'd better not get caught up in it. Just wait for it to completely unfold. But I have to tell you something. Although it's bullish in the sense that it has been posting higher lows, so in the most rudimentary basis, it's bullish. The non-existent momentum and the nature of this move higher is very uninspiring. Very. So I would be really looking to be short this. Not yet though, because as I said, this is a process. It might take more. It might surprise us and let's say accelerate to the upside. I doubt it, but it's a process. Let it do its thing, perhaps meet resistance once again there. And if we see an actual reversal there and the break, you know, below this wedge, I'm going to be interested then. Okay, but until then, I would say just stay away from it. It's slow, it's choppy. Nah, better things to do out there. But something to monitor for sure, because I think it's going to produce some good trading opportunity and most likely to the downside. I have a question. Did you buy euro yesterday when it dipped below 124? And the reason why? Thanks. No, I did not buy the euro when it dipped below 124. I'm passively long the euro through other things, as I've explained. So I am benefiting from the appreciation of the euro and no reason to add a trade to that. Okay, I said it some time ago as well. It's the blood moon effect, no question. Can you please talk about Aussie CAD? Yeah, absolutely. Let's have a look at it. Any thoughts on that? Triggered. What about Euro Pound? Okay, sure. Let's look at all of them. Euro Pound and then Aussie. Euro Pound and then Aussie CAD. Nothing to see with the Euro Pound, honestly. Just needs a lot of patience. You can see where we currently stand. I do believe that the chances of this getting a resolution to the downside for another push lower are higher. So if I had to be something the Euro Pound here, it would be short, but I'd rather be not involved with it, because look at it, slow overlapping price action. I mean, it just tires you watching it. I think that the market owes us another push to the downside. But I think you should rather look elsewhere. You see there's a descending channel here. Obviously, we need to break above it or below it to get anything going. But as I said, I think there are better opportunities to invest your capital out there. Aussie CAD, let's go. Okay, this was what we were expecting. We haven't viewed this in some time from what I see here. Some time ago, I said that when it was breaking above here, I said, you know, this can definitely create a move to the upside. Now, how big of that move is going to be, we can't be sure. Why? Because if you zoom out, I think this is not relevant so much anymore. If you zoom out, what do you see here? A big consolidation, right? So that was a nice trade if you wanted to take it, breaking out of this wedge, but how confident can you be of follow through since we're in the middle of a range? Not too much, I would be saying. So one more case that I would say from a personal perspective, I would rather stay away from it. It's usually not moving fast anywhere. It's in the middle of a big range. Nah, I wouldn't be doing anything with it at the moment. How do you resolve when one USD pair is impulsive short, another impulsive long? Do you then can go the cross or play? Absolutely, Bill. Absolutely. If you see a currency pair behave completely different against the same currency, let's say against the dollar in this case, than another one, then it means that it's probably a very good idea of checking out the cross rate. Yeah, absolutely.
We're into the interview time, Steve, so if you want to wrap it.
Yeah, we have questions about Sunil. I'm gonna, if you are on the webinar tomorrow, I'm gonna, please remind me, I'm gonna have a look at both of your questions about the Nifty and the USD with the Indian rupee. And if there is any more questions I missed because you know we ran out of time, I will be more than glad to look at them with you tomorrow, guys. So just write again tomorrow, and I'm going to prioritize them. Okay, thank you very much. Enjoy the interview, Dale.
Thanks so much, Steve. Nice analysis. Peter, before I pass the baton to you, I just have to show something here.
Stelio, if you're now here, can you please put the link for people to vote?
Vote
yes,
for
sir.
us. Vote for us. Vote for us.
Yeah, Stelios is going to put the link now down.
Okay, vote. Use your right to vote. Don't stay home. Go to the polls. Okay, Peter, I'm going to pass it to you, but I have to show the community this. So, you know, I've known Peter for a few years, and I've seen him call a lot of things very accurately, but I don't bug him and, you know, call him or Skype him every week and say, well, what's going on, Peter? What do you think? Yeah, because I have respect that, you know, it's hard work and people should be compensated for it. But I remember him talking about 80 in the S&P, talking about 2764 when we were, you know, hundreds of handles lower. So once we surpassed it, and I already had taken a position, a bearish position in an ETF, I got in touch with him. And I said, Peter, you know, because I know that even though he's looking for a correction, a wave 4, that, you know, he talked about 4,200 eventually in the S&P. So I sent him a Skype, you have the S&P top for wave 4 correction, and he comes back with this. That's what he expects. Strangely, he was using Bovespa for timing the exact top for S&Ps, and they were currently here at 8150. And I'm thinking, that's got to be a misprint. Maybe he means 85, 81 something. That's 4,000 points. I'm going, oh my God, the S&Ps are going to rally, you know, maybe another 50 handles. And they almost did it. But he was using the Bovespa for timing the S&P top, and he was looking for 85668. So here's where we were on Friday, 85530. I didn't know the Bovespa could rally 1,800 points in a day. And then we backed off in the S&P much deeper than Bovespa. So I'm going to ask him about it. It seems to be even stronger than the S&Ps. And now we're just a couple of hundred points above it. But anyway, very uncanny. We were down here, and the S&P's top Friday, very close to what he was looking for in the Bovespa. So I just wanted to share that. And now I'm going to make you the presenter, Peter. Welcome back, buddy. Hello, Peter Goodburn.
Can you hear me, Dale?
Yeah, Peter. Happy New Year. It's not too late to wish you Happy New Year. It's the last day of January.
Yeah, it sneaked it in. Yeah, you devil. Anyway, thanks a lot. Yeah, Happy New Year to you too. It's good to catch up. Thanks for the intro.
Okay.
I'm just looking at I've got my 4 monitors here. I'm not sure which one to select the right thing, so I'm just trying to work it out. So
okay.
Give me a second.
Yeah, take your time.
I'm just gonna. Oh yeah. Okay. I think this is it. actually, I think I can't see what you're seeing now because it's just flashed away. But if this is showing the S&P 500 on a weekly chart, is that what you're seeing?
That's what I see.
Okay. Well, that's the right thing, so that's good.
Okay, so it doesn't look like your the 3 has ended then. You're looking for 3,200 up there, like a lot of guys.
Yeah, I'm not sure what everybody else is saying, but we've seen such an enormous sort of upswing in January that it's basically prolonging the 5-wave impulse upswing from the 2016 low. So that's really the main criteria. We're not going to see a huge correction until we finish 5 waves up from 2016. I'll switch screens a second. You can see it on here. This is the what I call the grand resynchronization lows, because down at 1810 in February 16, this was when we had identified the dislocation between developed markets and emerging markets resynchronized, because in the previous 5-year period, if you remember, we've had copper prices, the MSCI Emerging Market Index topping out in 2011. We had a whole bunch of commodities, oil trading up and then down for 5 years. But that 5-year period of consolidation, whilst commodities and emerging markets were trading down, we did see, of course, the middle of a big 3rd wave upswing in some of the developed market indices like the S&P. So when we got to February 16, I made a very big statement saying that we've actually got a grand resynchronization of all of these developed and emerging markets coming together. Commodities have finished their 5-wave declines. We've got very typical corrective processes during that period of time. And the markets are realigned for the first time since October 11, when the markets underwent, in the S&P that is, underwent a 2nd wave correction. So this was a very, very big event, 2 years ago. We're sort of almost into the anniversary time of that. And we've had a very, very good stint to the upside. Trump has since become new president, of course, and given the whole thing an extra spurt. But basically, these trends were already engaged before him anyway. So whether it had been him or somebody else, perhaps even if Hillary had got in, it would have resulted in the same upswing. Who knows?
Okay,
but,
so I know there's a difference. This, because of the strength of this move, Peter, from last April, when you thought we might top around 2760, which back then seemed like an aggressive number, you said there might be a chance after this wave ends for maybe a 20% correction. That's off the table now because of the strength of this move on 3.
That's right. It's been really prolonged since the August retracement, which is basically down here. And so we've prolonged this. Now, the normal measurements that I use about sort of, I guess we were talking in terms of probability, about 80% terms of probability, you would expect to see a 5th wave run up like this, a 61/8 proportion of waves 1 to 3. And we've really exceeded that. It's quite unusual, but the 4th wave itself is quite tiny as well. So what we've done is, what I've done is I've extended waves 1 to 3 by 61/8, which produced a confluence of different targets up at 2860. And it was good to see that last week just poke its head slightly above and then drop down again, as we've seen Friday and into this week. So that's a good, what I would call a good rejection. So I'm just waiting now for a little 5-wave pattern to.
And you're thinking the most we see for a 4 down here is 23.6 of wave 5. Is that
wave 3? Yeah, it starts. We're measuring from here. See this low? This is the June 16 Brexit low, and we count up 1, 2, 3, 4, 5 like that. It's fairly simple. So this has to be, if you're putting in your Fibos, then you go up from here like this. Originally, I thought we might fall back to 38, but I think this bull market's so strong that I think that we'll probably emulate. It's going to be a little bit larger than the 2nd wave of same degree here, but 23% would be about right. So I've modified it a bit. to take into account of this rather extreme push up in January, which is added into the final fifth leg of this third from August. But over and above, you know, this is not this is not really detracting from the ultimate highs. You mentioned in the intro the long range targets up at 4,400. That's equivalent, don't forget, to Dow 41,000, which I had back in 2014, the end of 2014. So, you know, 41,000 on Dow doesn't look so glamorous anymore. It was a big call 2 years ago, well, what, 4 years ago, 3-4 years ago, but it's not such a big call anymore, is it?
Not as big. Still pretty big. Still a big call. But yeah, so so what would change your mind? Okay, I know every time you have a count, there's something that you have a kind of a line in the sand. What would it take for this count to change that you have up here right now?
Well, you mean change in terms that we don't get to see 4,400, for example, or what?
Or that this is going to be deeper than 2512.
Oh, well, we're not ready for 2512 yet. We've got to have this little. We've got about a 9% downswing first, and then an upswing here.
I see. Okay.
So this is. Let's do it like this. Let's make it into really easy terms to visualize. Well, you know, and everybody listening, you know that Elliott wave is all about trends are denoting in 5 waves, and they're fractal. So you know the subdivisions are going to be 5 as well. But this is how the 5-wave pattern's looking. Basically, you've had 1, 2, and 3. That's it. So we've got to get 4 and 5 to come. What we're talking about now is a 4th wave correction, 23%, and then a 5th later up here. And that 4th and 5th is really this little squiggle here, 4th and 5th in here. Okay. So once we get up to those numbers, then we're going to get the 20% drop that you referred to before.
I see.
Now, you know, going back to the breakdown of wave 3, this is the larger third wave, which begins, you know, this is it here. Now, originally, when we spoke about a year, or I don't know when it was, quite a long while ago, what we did was a very standard fib price ratio. We took 1 to 3, added to 4. This is how we got to 2760.
Right.
Okay, but we've broken a little bit. But that break is, I mean, that doesn't necessarily mean that it should negate that target, but I think it has, because we can't see a 5-wave completed structure from 2016. So that's why we're prolonging it. So the next ratio to use, for those of you who are interested in mastering some really good proprietary Elliott wave fib price ratios that we've discovered over the last 25 years, the next thing to do is you just go up here to the wave 3 again. But instead of doing a correlative ratio where you pull this down, so in other words, the 5th wave is 61.8% of waves 1 to 3, we extend above wave 3 like this, okay? And that produces the next target to 3250. So that's where I think we're probably going to be this year sometime.
All right. So let me ask you this. Last time we talked, the dollar was flirting with turning bad. I know probably it's weird, but I remember we were at 97-ish, and we did take it out. I remember you were saying, well, we have to hold 97 or we're going down. Where are you at with the dollar and euro?
Well, I mean, we've talked about confirming a major dollar high coming in, because one of the great calls that we've made, I've made, I guess, over the last interim period was basically due to the fact that
I thought maybe you have a few clones working with you now.
Now that would be useful.
I know I say we, but I'm at least a Gemini. I have a split personality. So, okay, so it looks like you're looking for a little counter trend move from right around where we're at here, or a little bit lower.
Yeah, we've got to go a bit lower. But the main thing from last year was this, and I'd just like to show everybody how effective, you know, these fib price ratios. We're basically describing the entire movement up from the March 08 low. So this is the low just prior to the financial crisis sell-off. When the financial crisis did get underway, we saw the dollar attract safe haven buying, so that's where it jumped up here into the March 09 high. This is basically either wave A of a zigzag, or it's the first zigzag in a double, but basically the measurements for both are the same. You extend by 61.8, that projects this blue line, and you can see it touches right at the top. Actually, it's 5 pips off. But that's also coincided with the 7.8-year cycle, and that's why last year we were so confident about saying that the dollar's in a topping phase, and we're basically looking for confirmation that it's going to confirm that as a top, and as the market starts to work its way down, we get confirmation. And since that time, we're moving down into a 5-wave process. So this is the way that we've labeled the decline so far. And what we've recognized is this is November's high at 95.15, and we're looking for this to finalize in the next month. And that will complete not only 5 waves down, and we're not quite ready yet. We're in a little bit of a finishing a third. We need a fourth and a fifth. Might be a tight squeeze to 87.72. I've got a slightly lower target using some other measurements. Well, I can show you those ones now that it's down here, 85 3/4. We could get that low. But in principle, we're getting closer and closer now to a terminal low of this 5-wave pattern down from January's high last year. So that generally means that we've got some pretty good, exciting stuff happening. Now, of course, if you're looking for a 5th wave decline finishing within the next month, either here or at 85 3/4, that means that we're then going to give way to a fairly sizable multi-month correction to the upside. Now, Elliott's guideline on that is that the correction would normally take us back to 4th preceding degree, which is up at 95. If we can find a fib price ratio retracement level that ties in with a 4th wave completion of preceding degree, that's great. Well, it happens to be at 95.40, which is good. That's assuming that we stop at 87.70. If it goes a bit lower, it'll be a little bit lower than that. But it gets us into the right territory. So I think we'll probably see a 50% retracement this year. But that means a fairly significant pull down on commodities. So when you think about things like copper, oil, oil's less sensitive to the dollar at the moment, but particularly copper, but more so on gold. That's going to be, something to watch. So what you've got to look for is that on this predication that we're going to see a counter trend rally at some point, and it's going to last several months, and it's going to be fairly sizable. In other words, we're going to return back to November's highs. Then you've got to be looking for confirmation to see if that's corroborated in some of these dollar-sensitive commodities. And if they are, then you have a pretty good forecast. And if they're not, then you have to go back to the scratch board and start working why you're not seeing it.
Okay. So during this time frame, gold's going to be vulnerable because it's been threatening before last week's pullback a weekly breakout over 1350. So wondering what you're thinking, how deep could the pullback be in gold when the dollar finally turns back up?
Yeah, well, let's say that is it possible first? I mean, if gold, at the moment, I think the market's poised for let's look. Well, no, I don't want to show you gold until I just mentioned this. The market's basically poised for a sustainable breakout. You've probably heard it on the news wires. A lot of analysts are talking that if gold breaks 1375, which is the July 16 high, we're really going to start pushing on. And I think it can only do that if you could look at a sustainable dollar decline at this juncture. I don't think that's possible. And of course, you probably heard that Bill Gross recently has talked about yields surpassing 3% even more, and that's whipping up a lot of enthusiasm for the 10-year Treasury yields, because We've just recently broken 260, which is the high for the last year. And,
yeah, it was kind of like a neckline, 262, that measures about 3%. You have a different take on yields?
Yes, and I'm gonna come to yields after gold, but I just want to give everybody a bit of an introduction to what I'm expecting, because I see this is going to be a fake out, not a breakout on treasury yields and gold. Why? Because of the dollar. Because if the dollar is correctly interpreted here as in a process of concluding a fifth wave decline, then and it does give way to a multi-month correction to the upside, and that could burn us right the way through into the summer months. Then of course it's a game changer. It's a game changer for a lot of different other asset classes. Now,
how come the stock market likes both a weak dollar, and I've kind of seen that it almost likes a weaker dollar more than a stronger dollar recently? Why would only gold and not stock indices be vulnerable during this phase of a 50% retrace in the dollar?
Well, I think that to a large extent the market's pretty confused whether the dollar weaker sort of mandate, which Steve Mnuchin has endorsed, or as opposed to the official line which Trump retracts and says no, we want stronger dollar. I don't think anybody really knows what it's meant to do for stock indices. I think it's relative maybe to some fund managers that I speak to in terms of how we advise as a company, like some of the large big fund managers about performance, because obviously if you're looking at maybe a weaker dollar, perhaps you might get eventually some outperformance in some of the big large caps because of their export ability, and they're going to earn more profits if they sell overseas with a weaker dollar. Right. It could flip around, during that phase. I think if you get a flip around and the dollar goes up, you'll probably find that we get back to maybe some outperformance in the small caps or something like that. Okay. So performance, I think, is relative speaking, but I don't think that really it's got a huge impact at the moment. And as you can see, it's fueling large caps more than it has the small caps recently with this extra decline in the dollar. So that seems to make a lot of sense to me.
Yeah, Russell's been underperforming quite a bit, but
yes.
You think that changes when the dollar changes? So they'll rotate out of multinationals into domestic.
I think we'll see those rotations continuously this year. At the moment, everybody's playing the banks long because of interest rates rising. They think that the flat yield curve is not so detrimental to the bank's profits at the moment. If we were at a later date to see the yield curve start to steepen, then of course the banks would look even more attractive. But I think they're vulnerable. I think they're a bit overweighted at the moment, the bank stock. So I'm advising our big clients to sort of start working off some of their long positioning in the banks, and start to look elsewhere. Of course, if we start to get a stronger stock market decline, as people start to realize we've got maybe a 9% drop, you might start to getting some rallies in some other things, in other sectors, which are more defensive.
Yeah, I think that started to happen last week. The staples, the utilities, the REITs, more defensive last week.
Yeah, I haven't had a chance to look at the consumer staples index, and we do monitor that. So I won't bring up a chart on that right now because I haven't had a chance to look at it. But I think that rotation could still occur, and I think that will continue to occur this year. I think we've got quite a big task on our hands as a company, at least ourselves, to ensure that we get the rotations right. I think that's going to be, but I think that is tied to the dollar too, as you quite correctly say. Now let's look at gold. Now let's just assume for a moment I'm correct. We get a dollar low and we start a multi-month correction. How can that you know, how can that happen if the market is correct in thinking that once we get above 1375, it's going to go to the moon? Well, my version of events for gold will be this: that we'll break up above 1375, but again, it's a fake out, not a breakout, and that's very important. So this will suck in some investors, maybe some of the big funds even, because they're notorious for getting their timing wrong. And I believe that we'll get to 1416, then drop really hard and fall all the way back inside the range.
Wow.
Now, this is a conservative downside target for a running flat. An expanding flat would necessitate a drop below here. Now, the reason for that is because of the dollar, but there's another reason too. Earlier this year, or last year, I should say, when we got to July, we actually pinpointed this low pretty precisely and gave all our clients a buy signal for gold at this point. To my amazement, it ran up to 1357, not in 5 waves as I was expecting at the time, but it had this distinct correction in the middle of the 2 upswings that occurred. And that is, in Elliott wave at least, terms a definition of a 3-wave corrective zigzag pattern. And that's the big problem that I have. That 3-wave price picture, I've seen a few Elliott guys try and make that into a 5-wave picture, but to be honest, if you do that, then you can't tell the difference between a banana and an orange. I'm sorry. That's not a 5-wave impulse sequence, and so I think that's a bit of a clue to what's going on. That's certainly replicated in things like silver prices as well. Now, when we got this correction down in December, we started this next impulse. I've basically labeled those 2 sequences as part of
just want to remind viewers, Peter, that if they look to the left-hand side of your chart, you were spot on for that low at the end of 2015, early 2016 for that big rally. And eventually you were looking for 1900 gold. So it looks like since that big run, what we've seen for a few years is just a big ABC corrective pattern, and that we'll get the end of 2 down there at 1150 and then be on our way to sharply higher numbers, 1.618 maybe of wave 1. Which would be about $500 or so.
That's right. Yeah, I mean, there's no doubt about it that the medium-term outlook is extremely bullish. But the timing of that next big primary 3rd wave, well, we've had a few false starts. I mean, we got a nice deep correction here. Yeah. This was originally thought to be primary wave 2. I thought it was primary wave 2. You wouldn't think otherwise. And it's only recently that we're beginning to realize that. Don't forget, this is the low. December 16, January 17 was the peak in the dollar. Okay, so whilst the dollar's moving down from exactly that peak, here you've got gold moving up. Except one thing, gold, the dollar index, the DXY is moving down in 5 waves, approaching a completion but not quite yet ready. Whilst this is moving up in a very overlapping sequence, a corrective format. And of course, as part of as the second wave of an expanding or a running flat pattern, it's required to break above the previous high, suck in the longs, and then dump them as it drops back inside the range. And I think that's going to be our fake out rather than the breakout, the sustainable breakout that the market's expecting. So I think there's 2 clues. One is the dollar. The other one is this July-September upswing being a zigzag. I think that's giving us the impression that we're potentially in a fake out scenario. Now, I keep telling my clients when I show them these charts and I explain to them, especially some of the big fund managers, that they should already be long from December. We did give a buy signal then. And we've actually, for the traders, we've sold out our positioning. We're waiting for a reset down here. And I want to buy it again. I do want to buy it, just in case I'm wrong. I mean, I'm not infallible. I think I do thorough research, but I may not be infallible. So what I'm looking at now is to buy on this retracement. I want to be long into this run up.
You're not Pope Peter, are you?
Haven't been anointed.
Then you'd be.
No.
Then you'd be.
Haven't been-
All right, go ahead.
Haven't been anointed as an English Anglican. No, I'm not allowed even to go and you know, take bread from the Pope. He won't give it to me.
You'll
So,
end up in the guillotine. All right.
no,
So,
I'm something similar. Yeah, I think so. I'm on the bad list. But I'll show you why I think 1416 is very important. Again, this is using our proprietary technique of fib price ratios. If we extend this first zigzag upswing by 61.8, it projects this blue line. You can see that's, if I round it up to 1416. For a B wave, the second sequence in an expanding or running flat, we must extend wave A by some subliminal fib price ratios. You can use 3. Prior to this move up, you would be using 3, 14.58,
okay.
23,
So this would be
38.
what some Elliottians call an irregular B because it takes out the high of A.
Exactly.
All right.
Exactly. You're
And that's
spot
a
on.
big fake out because people are saying new highs. How could it be a B wave? You know, because it should be a lower high. But there are a lot of irregulars.
Yeah, the irregular flat or the expanding flat is where you get a slight price extreme in the B wave, and then it falls back inside the range again. So we've extended wave A here by 14.58%, and you can see that there's a nice convergence matrix. So this is why I'm thinking this number is going to be particularly relevant. We'll be buying on this dip, and we'll be taking it up. All the hedges will give them buy signals up here, and if we break that on a sustainable level, we'll keep holding and maybe even adding to our position. But if we see price rejection there and an obvious reversal signature, that means it goes up, touches that number, not too much deviation, and then suddenly you get a swing down of about 20 bucks. And 1 minute you're 14.6.
Could we have a quick look at oil with what's happening? You know, oil to me, with all the commercials being very short for a while. Are you looking for a pullback here before we march higher? It looks like you are.
Yeah, I had a this is last week's forecast. It's moved down, so I've got to update that today because we're posting our next report tonight.
Okay, you're looking for almost 90 bucks before it's over.
Yes. Well, we've got 2 upside targets. Now, this is a rather intriguing thing. We've just published our triple video series, which basically is our annual 2018 forecast across 3 different asset classes. Now, in the commodities part 2 series, I include very specific reasons why these 2 upside targets to 78.90 here and to 87.90 will be extremely important in determining what oil does once we reach these numbers for the next few years. So it's a bit of a plug for my video series, but I mean, look, if I didn't write it myself, I would still buy it because I think it's really good. But let me just tell you now, for yourself and for your listeners and watchers, why it's important. Because we're recognizing that the upswing from the grand resynchronization lows here into this June 16 high, that's a 5-wave pattern. It's labeled primary wave A of a zigzag. Now, if we extend by 61.8, which is a normal ratio we use to depict wave C's terminal high, we get to 78.90. That's the blue line here. But sometimes, if you have a running flat, look here, this is a running flat in oil, similar to what I've described on gold. We came down from June last year into this low in August 16. Then we ran up into a slightly higher high, so we broke the previous high in a fake out. And I actually was in London around this time doing a presentation in front of some very big fund managers, and they were all super bullish for oil. And I said, no, actually, this is going to drop really hard for the next 6 months. We're putting all the way back inside the range. And for an expanding flat, the targets would have been a couple of dollars below here. So I told them, yes, that could happen. but you shouldn't be so long here. You should be unwinding your positions, because I mean, if you remember back then, the speculative net long positioning was extremely high, and I knew that this was going to drop, and so we did, and we got down to $42, and that's a good example of a running flag, which I showed on gold just now.
Right.
So you make a breakout, but it's really a fake out, and then eventually it flops all the way back down inside the range. Anyway, that was wave B. But what we can do, because we have a higher high in the fake out phase, we can also extend that by 61.8 like this. So wave C, that would also project a slightly higher, well, a lot higher target, another $10 up to almost 88 bucks. Now there's long-term implications for that, because if we stop at, say, the lower target at 78.90 later this year, and then we undergo we change direction from that 78.90 point, that could leave open the door to a very, very weak outlook for oil, for whatever reason, for the next few years. But I don't think it's going to do that. I think we have a chance of trading up to 88 this year, and then falling back in a correction, and then we're going to get a secondary zigzag to new record highs. And that's basically some of the charts that I've shown in our video series. I think they're really important.
Over 140.
Yes, above 147, which was the old high you saw in July 08.
Okay.
We're gonna get a lot higher than that. So it's a double zigzag. It's a correction. It's going to be wave B within the super cycle.
Okay.
And again, we're talking about an expanding flat. So these movements up here as a double zigzag above 147 represents cycle wave B within a really huge multi-decennial expanding flat. And that's why this could be, this could be part of the inflation pop series where we expect all commodities over the next several years to still bubble, and we make a big push up across into the next decade, into the early part of the next decade, and we have an inflation pop which eventually bursts in that time frame.
Okay. Around the generational high in equities around 2020.
That's it. Yes, absolutely. So by the time this secondary zigzag unfolds to new record highs, you'll get the Dow up to 41,000.
Okay. You want to wrap
it out together.
You want to wrap it with yields, and does that tie in with the dollar? Dollar rally, bond rally?
Well, at the moment, don't forget the dollar's been declining for 12 months from
with
last
the yields
year's
going
highs.
up.
With
That's
yields
why
going up.
Yeah. Okay.
And that's,
right.
I think,
you're looking for a pullback in yields from 280.
well, this is the fake out that I mentioned earlier again.
Yeah.
So it's not just gold that's going to go through a fake out, it's 10-year yield. So I think that we've got another 10 basis points to go. We get up to this 280, 282 area. And I wouldn't be a bit surprised then if it falls back inside the range. I know the market's expecting this to push on way above 3%, even more.
Right.
But I don't believe that's going to happen. I think that this is going to fall back inside the range, and that gradually this year you'll start finding the investment banks, the analysis from the investment banks, they'll start to write down the 3 or 4 rate hikes that they're expecting currently. They'll start basically unwinding those down to maybe 2 rate hikes for the year or something like that.
Interesting. So if that's a B down there at 193, from there, are you expecting sharply higher yields?
Well, then we go to the next big picture, don't we? And then we start looking at this move up to 4.5.
Okay. Yeah. Okay.
But the question is, are we already in that phase to 4.5 now?
Yeah.
That's what the market expect. Well, I don't think 4.5, but they're expecting maybe 3, 3.25. But from an Elliott point of view, if wave B was the low last September here, that would be the target still. But I think we're going to pull back inside the range. It sounds speculative, and we need confirmation, of course, but I think that's a viable proposition. And the only way to really be sure about that is cross-referencing. We do a lot of We do a lot of work on 10-10 spreads. We take a look at the Bund yields here in Europe, and we make correlations to give us an impression. We don't just rely on this one single piece of analysis to come up with these ideas. We've got to make sure that it's fairly sound and solid across different different.
Another great interview by you, yourself, and I. All right.
Was I in there somewhere? Was I in there somewhere? Of course.
Yeah, I was there. You, yourself, and I. Triplets. Thank you so much, Peter. Some real interesting views, some contrarian views, and what's the best way for people to follow you or subscribe? You want to show your website?
Oh, thanks. Yeah, let's see. Here we go. This is wavetrack.com, and if anybody's interested in picking up some of the themes and some of the forecasts that we make, we're very I think from an Elliott perspective, we're unique in terms of the way in which we use fib price ratios. We learned this technique through trial and error because over the years, over the last 25 years, when we've been advising top funds, sovereign wealth funds across the world, these guys need to know exact levels because it tells them how much they should put their foot down on the accelerator or how much to put on the brakes. So
and you're covering crypto now too, huh?
Yes, I'm starting a bit of Bitcoin for those, and tonight's report will also have some Bitcoin in. But what you can do is you just come to our website and just go into products subscription. And if you want to subscribe to the Elliott Wave Compass report, this is here. It's our private client entry level, and not very expensive, very competitive, and you'll get a lot of the different markets that we've discussed today embedded in there. So that's one way. And don't forget also, if you go to our blog, you will find information about how to subscribe to the video series. And the last one, the part 3 series, which is currencies and fixed income, we published earlier this week. Here it is. And if you just go to the main website, click on the blog section, you can find us there, and it tells you how to subscribe to that too.
I encourage people to check out Peter and definitely go over this video and put all of this input into your trading arsenal. So Peter, I want to thank you so much. I consider you my trading warrior brother and friend, and thank you for coming here, Edifying Face, once again, and giving us some great looks on your work with both your microscope and telescope. Appreciate it very much.
Thanks, Dale, and it's a great pleasure to speak to you, and I really hope that we can remain in contact regularly. Okay,
buddy, count on it. It's a promise. Everyone, that's Peter Goodburn. So you can follow him at Elliott Track. What's the Twitter handle again, Peter, before I let you go?
Good point.
Because it's got an underline there somewhere.
Here we go.
There it is. At Elliott Wave underline WTI.
Yeah, here it is here.
Okay, buddy. All right, well, good hunting, people. I'll talk to you soon. Keep in touch. Everybody, that's our Wednesday session. Remember, don't just count your pips, count your blessings. And have a great day. See everyone in the private chat. And don't forget to vote for ForexAnalytix as best new contributor on FX Street. And test drive our traffic light page. Adios, everyone. Thank you, Peter.